I'm Howie Lim. This is Money Hacks by the Business Times. Today we're going to talk about retail investing being fundamentally disconnected from real performance. That's the feeling anyway. We spend so much time debating which stocks to buy, but we rarely ask who actually designs the investment products and why they're built this way. There's an unspoken wall, I think, between the institutional world, sovereign wealth funds and global asset managers and the like, and the retail investor, Joe Regular. So today, we're going to try and tear down this wall. David Ng, the founder of Arki Finance, isn't here to give you another stock tip. He's here to reveal the structural disconnect between how the big money builds portfolios and why your bank's probably going to sell you something that's watered down. Will he reveal the secrets of institutional asset allocation? Let's hope so. David, thank you for joining us today.
Thank you for having me.
So I want to start, David, with product fallacy. You spent your career at the institutional level where strategies are built to survive decades, not quarters. When you look at the average wealth management products sold today to the mass affluent, what's the single biggest design flaw that you see that an institutional investor would never accept?
When I used to serve institutional investors, I don't go to them asking them to buy this product from me. It always starts with the client needs. We ask them, what are investment objectives? What's the risk return objectives you're looking for? What are constraints that we have to work on? And when is the horizon that you actually need the funds back? And then we portfolio construct, get an investment solution that specifically meets the client's needs. The solutioning that we always have will always meet the client needs perfectly. Now, in the retail wealth management sector, I think the process is actually reversed. It actually starts with the product. The product is really built. We ask the retail investors a couple of risk tolerance questions about their investment objectives, and it gets bunched into three buckets, conservative, balance, or growth. And we'll probably give them the right product. But if you think about individuals' lives, it's actually a lot more nuanced than that because people have aspirations. We have housing goals. We want to save for our children's education. These are very nuanced, and these are capital that's needed for different milestones in life. In investment terms, we actually have to look at investment horizons to actually get the right investment solution for that particular horizon. So I think that's the disconnect that I actually see between retail wealth management and institutional asset management.
Isn't it a middleman problem? No, because you've seen the industry from inside at CSOP, I believe,
Yes.
And now you're running your own firm. What is the one thing the financial industry hopes the average investor never figures out?
I wouldn't.
How fees and performance are actually aligned.
I would actually challenge that premise that the industry actually has something to hide. There are many good financial institutions, good financial professionals that act with thought, integrity, and fiduciary care to the clients.
What kind of clients, maybe, is the question? Wealthier clients, yeah lah, but...
Or retail clients even, the lower segment of wealth. I think the important question for the investors to ask is, what does the fees actually incentivize? What kind of behavior incentivize? If the business model, say for a financial institution, is based on trading activity, and that's how it makes its revenue, I think that's the behavior that the financial institution will encourage of their clients to get a lot more trading activity going on so they can earn fees. If the business model and economic incentive incentivizes distribution of a particular product, then that's what we're going to see. The very important question for the investor to ask is, what value exactly am I getting out of this service? And is the economic incentive that the firm is operating on actually aligns with the outcomes I want to achieve? That's an important question. And quite frankly, high fees may justify if it delivers the better financial outcomes, delivers a proper service in terms of behavioral coaching, financial planning to the retail investors, and they actually achieve their financial aspirations. I think that's a justified fee. Even if something is low fee, if it does not deliver the outcomes that the retail investor actually needs, then I don't think that's actually a misalignment happening there.
Let's talk about this rote advice that's often given to retail investors.
Yep.
Diversify, for example, is one of them. But you've hinted that this is often a lazy excuse for the lack of real conviction. What does true institutional diversification look like, maybe, versus the tick box diversification that regular investors or retail investors are often given?
Well, I'll actually caveat that diversification is actually a really important discipline in finance.
No doubt.
Yeah.
But there is this, for example, I have the privilege of working at the Business Times and keeping an eye on these things. And say, for example, buying into an index that's the most diversified you can be. But right now, some indexes are really tech heavy. So you're no longer really diversified. Do you know what I mean?
Thanks, Howie. You actually raised a very good point, right? Because a lot of investors actually in the retail segment, they think of diversifying as buying as many products as possible, like as many companies within an index as possible. Well, that is, to me, false diversification, right? Think about it. If you buy ABC index fund and invest in US equity companies, and then you buy a CDF investment fund that invests in a sector of that particular S&P 500. And these are all exposed to the same companies. Would you call that diversification if they actually happen to move along the same way when a market event actually happens? So people fall under the fallacy that I have as many products as possible to get diversification. But on the institutional level, we think of diversification as a reduction of risk. We consider that in a lot more detail. We think about currency risk, interest rate risk, carry risk, equity risk, etc., etc., etc. And the decision framework that we actually take is if I choose to add something to my portfolio, specifically, what does it reduce for me? And what outcomes will I get from that? For example, if I were to manage, say, liquidity risk for my portfolio, what is the one instrument that could actually help me to manage that? Is it across specific horizons, across specific geographies? And these are questions that we considered. So it's actually a very robust methodical framework that we go about in terms of trying to diversify. It's not diversifying for the sake of diversifying or just buying as many things as possible.
Spray and pray type.
Yeah, that's right.
Okay, still to come, we get that institutional portfolios can be complex. That's why they have the big brains managing them. But what about on the retail front? Why is that complex? It feels as well, David. We'll get your advice in just a moment. Stay with us here on Money Hacks.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back. David, the failure of intuition. When you're managing institutional what was the biggest mistake even professionals made? Why are retail investors doomed to repeat those same errors, you think?
If you think about it, Howie, institutions are actually run by people, humans.
Sure,
right?
but big brains, ma.
Big brains, lots of very intelligent people with lots of experience. Naturally, you fall into that assumption that intelligence, experience becomes the foundation of informed decision-making. If institutions are run by humans, there must be behavioral biases that an individual or group of individuals are susceptible to. Confidence, fear, greed. But what institutions do quite differently is that we actually have frameworks and guardrails in place to correct these sort of inherent weaknesses. Because you think about investment mandates, you think about risk limits, you think about a decision framework. These are all institutionalized, and it helps the institution manage their investment in a structured manner that is repeatable over time. So I guess for the retail investors, they don't have that sort of guardrails and structure in place because a lot of distractions in your life to manage unless you're doing this full time. Can you imagine trying to do a risk management for yourself and putting risk limits on your portfolio and watching it constantly 24/7? Institutions do that in a very structured manner with professionals, with a group of people that does it on a very consistent basis.
What about the cost of complexity, though? Is there a cost if you want that sort of complexity or nuance, let's say? Institutional portfolios can be incredibly complex, yet these frameworks, which are aimed at, I feel, to make it less complex, Because the complexity found in traditional banking is designed to, say, justify high fees, right? Then would it be at the cost of actually generating alpha?
I would just kind of push back on that premise a little bit that complexity is structured just because financial institutions want to earn high fees. Sometimes complexity is absolutely necessary. If you think about a pension fund with a 30-year liability, there's a lot of competing priorities for the usage of the funds. The solutioning inevitably will have to be complex. The question I always come back to, or the principle I come back to, is when we are adding this layer of complexity to a specific product, what objectives are we trying to achieve for the client? Even for retail clients, I think it's very important to understand the objectives the clients are trying to achieve, whether it's going to be short-term liquidity issues that they might be faced with, or they are looking to long-term goals like their children's education. I think it's important to understand what's the purpose of the capital, why they actually need it, and what's the best way to get to it. Sometimes the true sophistication is finding the simplest possible solution to achieve the objectives. So I think most people try to confuse sophistication and complexity. And some complexity, I do agree, it can be completely unnecessary. But let's start with the client. What's their purpose of the capital that they're actually putting out for risk?
So, David, you setting up Arki Finance is a hope to bridge the gap between institutional tactics and retail access, because Joe Regular will can't afford fees, I suppose. And when does the bridge fail, though, you think? Because what's the one market scenario where institutional strategies become toxic for Joe Regular, that we shouldn't use them because maybe we don't have the deep pockets? I don't know.
Well, I think the bridge fails when we try to confuse institutional products versus the institutional principle we hope to impart to retail investors. When institutional solutions start to become toxic is when there is actually a mismatch between an investment solutioning to the client objectives they want to achieve. Someone looking to buy a house in, say, 12 months, and he's telling me that his risk is aggressive. Do I actually put him into a high-risk fund that's going to return a high annualized return when he actually needs the money in 12 months' time? So without understanding his purpose of the usage of the funds, I probably would have done that. And then would I...
But he said it, right? He was willing to take risk.
Yeah, he said it. But the issue is, as a investment professional, we know that investment risk, especially for investment products that has a long time horizon to work out, because when we speak about annualized returns, generally we talk about averages over a long period of time as opposed to, say, 6 months or 12 months. And to the client who needs his house in 12 months' time, it's going to be a hard sell. The combination of not understanding the client and taking excessive leverage that institutions typically use in their portfolios could be extremely toxic to the retail investor. In recent times, when we have news articles in Korea, where we talk about leverage indices being sold to retail, and they actually suffered for it because of the use of margin.
What truth, so to speak, are retail investors clinging to where it leads them to make this mistake? It's the one institutional wisdom that they think applies to them, but it's completely irrelevant, actually.
Sometimes we always go around this question, how's my investment portfolio compared to the benchmark, right?
Okay, what's the benchmark?
Benchmark could be a S&P 500, MSCI World Index, and this is actually very commonly used in institutional world to justify their performance over and above the index. All well and good for investment professionals, for financial institutions, right? But if you think about the retail investor, the biggest priority for them is that your investment portfolio is actually designed to fund all your milestones in your life, your aspirations in your life. And that is not something that could be measured by a benchmark, because a children's education, your son or daughter is going to tertiary studies in the US, and you require $250,000. You need it in 12 months to 24 months' time. And then would you complain if the benchmark is performing or underperforming? Or would you actually care about in 12 to 24 months' time, I will be happy about the probability of receiving that sum of money that I need to fund my children's education? And I think people often confuse maximizing return versus optimizing for the financial outcomes that they actually really desire. It's quite different. Probably I will add for the retail investors, they think about investment returns. as one singular capital allocation, like they are managing like a hedge fund, right? But an individual can have their needs for their wealth in different time horizons. Could be they need their money in 12 months' time, 5 years' time, and maybe 20 years' time. And these pools of capital needs to be treated differently because they have different investment time horizon, different objectives to be achieved. Their whole objective is to basically maximize the return, just like how a hedge fund would do. But then the hedge fund has one singular objective, which is basically maximize returns for their investors, whereas the retail investor, they have multiple objectives to consider.
Yeah, I wish we had more time though, David, to really go into all of this. Thank you so much for sharing your insights.
No, thank you for having me.
David Ng is the founder of Arki Finance. This has been Money Hacks by the Business Times. I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.